Hello, everyone. Adam Bergman here, tax attorney and founder of IRA Financial. And on today's video, the solo 401k versus the SEP IRA. What's best for me in 2024? So this is an important video. Why? Because if you are self-employed or you have a business, small business with no full-time employees, other than the owners or their spouses, you're going to want to decide between setting up a solo K and a SEP IRA. And if you want to know all the answers you're going to need to make a thoughtful decision, and hopefully the correct decision, this is the video for you. I've written 2 books on the solo 401k, 8 books in total. So there's not many people in the country that I believe know more about solo 401ks and self-directed IRAs than I do. So if you give me the next, 20 or so minutes of your time, I promise you, I'm going to teach you all you need to do about the solo K or the SEP IRA. So let's start with the solo K, since I think it's the most robust and powerful retirement plan for the self-employed. And I'm going to focus on 2024 because that's where we're at. And that's what you're going to need to know. So in 2024, the most you can put away in a solo K if you are under the age of 50 is $69,000. That's up from 66 in 2023, or 76,500 if you're over 50, and that's up from 73,500 in 2023. However, to get to that number, there's multiple components. So there's the employee deferral component and the employer profit sharing contribution component. In 24, employee deferral, which is dollar for dollar, pre-tax or Roth, the most you can put away is $23K if you're under 50, $30,500 if you're over 50. And that is up from $22,500 in 2023, $30,000 in 2023 if you're over 50. And then the remaining bucket is the employer profit sharing contribution, which if you're sole proprietor, single member LLC, 20% of your comp, Schedule C. And if you're 25%, if you're a C or S Corp, 25% of your W-2. And when you aggregate the employee deferral and the employer, you can't go above the 69 or the 76.5 if you're over the age of 50 years old. So employee deferral, I mentioned pre-tax or Roth. Employer profit sharing contribution starting in 24 also could be a pre-tax or Roth. That's a company contribution. However, if the company elects to do a Roth contribution, it's after tax, meaning you have to pay tax on the amount that was contributed on your behalf as an employer contribution. And then, of course, once you're over 59 and a half, you can pull those funds out tax-free, assuming the account's been open at least 5 years. So the number one reason to do solo over SEP, and I'm just going to list the reasonings for doing it, is the contributions. That's why I started the video with contributions. Okay, a SEP IRA, you can put away $69,000 if you're under or over 50. There is no catch-up. 2023 was $66K, right? You compare 69 in 24 in a solo K. If you're over 50, you can do 76.5. But that's just the beginning of the formula. A SEP IRA is a pure profit sharing plan. And I'll get to the eligibility requirements in a minute for both the SEP and the solo, but really wanted to just touch on the contribution aspects first, because that is usually the deciding factor of whether you're going SEP or if you're going to do a solo K in 2024. That really should be the first criteria you look at. So let's go with a couple examples, because I think that generally tells the story the best. Simple example, you make 100K, you're under 50 years old, sole proprietor, single member LLC. Solo K is going to let you do 23 plus 20% of 100, giving you $43,000. And that could be pre-tax or Roth. If you did a SEP IRA, all you'd be able to do is 20% of 100 or 20, right? 43 obviously is a lot more than 20. Kind of an easy answer. How about you make 60K, okay? W-2, right? So over 50. Solo K will let you do 30,500 plus 25%. Well, let's say sole proprietor, 20% of 60, another 12. That's 42,500. if you did a SEP IRA, all you'd be able to do is 20% of 60 or 12, right? It's almost 3 times more. So back to the 100K example, S Corp over 50, the SEP's only going to let you do 25% of 100 or 25,000. The solo K will let you do 30,500 plus 25% of 100 or 55,500. So you can see, right? The numbers don't lie. Pretty simple. The solo K also has something called a mega backdoor Roth, which the SEP IRA does not have. The mega backdoor Roth will let you go dollar for dollar, all in Roth, up to 69 or 76.5. Right? So if you're a Roth lover like I am, you could dump a lot more money in a Roth solo K than you could at the SEP. Why would you ever do SEP? Really, the only reason, if you're under 50 years old, let's say you make 500K and you're going to max out, then that 69K, now that the SEP IRA also gives you a pre-tax option and a Roth option, the SEP and the solo K are pretty much equal if you're under 50 years old and are going to max out. So that's really the only time I would do a SEP. Let's get into eligibility, because there's one wrinkle that actually benefits the SEP a little bit over the solo K, but only very, very I think indiscreetly. So start with the SEP IRA. In order to offer benefits as a business to employees of your SEP, number one, you have to have a business, right? Only a business can set up a SEP, right? What's a business? You sell a widget, sell a service. Could be a sole proprietor, single member LC, C Corp, S Corp. It's got to have a business. Someone has to be 21. You have to work for the business at least 3 of the last 5 years, which is key, right? Because if you have a new business and you have no full-time employees, the minute you hire an employee, you don't have to offer them SEP benefits until they work 3 out of the last 5 years. So that gives you some flexibility to make contributions for you and not your employee until they've worked 3 of the last 5 years. Also, they have to have worked and earned compensation of at least $750, okay, which obviously isn't a big deal. So the 3 of the 5 is one other wrinkle why a SEP IRA may have some advantages over a solo. With a solo K for eligibility, you also have to have a business, but you can't have any full-time employees, which is 1,000 hours and 3 consecutive years of 500 hours or more. That 3 is going to go to 2 consecutive years of 500 hours or more in 25. But in 2024, it's 1,000 hours and 3 consecutive years of 500 hours or more. Now, again, that's only for non-owner employees. Spouses do not count as employees under ERISA. So if it's me and my wife, we have a business, even though she's not an owner and I pay her a W-2, still can set up a solo K because she's not technically an employee. Or let's say I have an ice cream shop in Maine and maybe I only hire high school, college kids. They work maybe 300-400 hours, 500 hours a summer. I can have them in my solo and do not have to offer them solo 401k benefits because they're not deemed an employee. 3 consecutive years of 500 hours or more. SEP IRA, I can have someone full-time technically, but if they've not worked for me 3 of the last 5 years, technically I don't have to offer them SEP benefits. So that's an advantage if you have a business and want to set up a retirement plan, maybe do not want to set and provide all your employees benefits. If you have some new employees, you may have some flexibility under the 3 out of 5 year rule. The solo K doesn't have a 3 out of the 5 year rule. It basically says 1,000 hours or 3 consecutive years of 500 hours or more. When do you need to set up a plan? Okay, so SEP IRA and now a solo 401k, if you want to set up a plan and make 2023 contributions for a SEP IRA, you can set up the plan anytime before the company files its return. So if it's a sole proprietor, it's April 15th, October 15th for an extension, because that's a 1040. If it's a C or S Corp, it's an 1120, either March 15th or April 15th, or extension September 15th or October 15th. Since a SEP IRA is a pure profit sharing plan, you can do contributions for 23 in 24 up until the company files a return, including an extension. Solo K is a little bit different. For sole proprietors and single member LCs starting in 24, you can set up a plan in 24 and make contributions for the 23 year up until the company files its return, April 15th or October 15th. For a W-2 C or S Corp, technically the W-2 contributions, the employee deferral should be done by 12/31, but the profit sharing can be done up until the company files its return. So you have flexibility, much like a SEP and a solo K for a sole proprietor, single member LLC. Don't worry if kind of this thing, all the information I'm talking about seems a bit complex. Just, we have an amazing team of tax professional specialists that are trained on this stuff. Call us, contact us, email us. We will help structure a plan. We'll help customize a plan that works best for you. We'll help you digest all these rules to make sure you take advantage of all available contributions, whether it's for 23 or 24. So don't stress out. We're here to help. We don't just give you the plan and kind of say, good luck. No, we'll be there with you for the setup, for the administration, for the record keeping, and obviously, and I think most importantly, for the ongoing consultation. That's what we specialize in, and I think that's what we do better than any company. So number one reason to set up a solo over the SEP is the high contributions, which I just mentioned. Number two, I would say the loan feature. With a solo K, you can borrow the lesser of $50,000 or 50% of your account value, whatever's less. Use that for any purpose. SEP IRA does not have a loan feature. You can't borrow a dollar from your SEP. You can do a 60-day indirect rollover once every 12 months, where you can pull funds from the plan every 60 days. Well, for 60 days, once every 12 months, but you got to put those funds back within 60 days. Solo K is a 5-year loan, okay, and you're paying yourself back. So the interest rate is high. Right now, it's January, 10th or 11th, 2024. It's an 8.5% interest rate. That's the lowest prime rate you can do. Obviously, that's a lot higher than COVID, which was 3.25%. But the advantage of the loan is you're paying yourself back. So you get tax-free, penalty-free use of the funds, and you're paying yourself back. So it's kind of like a guaranteed 8.5% rate of return on your investment, which is pretty cool. So that's the advantage of the solo K loan. You can use it to pay off medical bill, a credit card bill, is going on vacation, buy yourself a car, do whatever you want. There's no limitations on what you do with the money. It's a 5-year loan, payable at least quarterly. So it's a straight loan, principal and interest combined, but you're paying yourself back. You just need to make sure that obviously you can pay back the loan. If you fail to pay back the loan, it's taxable distribution. But you can do multiple loans, right? So let's say you have $100K balance in your 401K. You can do $50K. You can do multiple loans, maybe 5 loans of $10K or 2 loans of $25K or just 1 loan of $15K, whatever you want. You have some flexibility. Good news is you're paying yourself back, and you're not paying back a credit card company or at a 25% interest rate. You're paying yourself back at a minimum interest rate of prime, which is now 8.5%. Some folks may want to wait. They feel interest rates are going to come down in the next 6-10 months. So maybe they can wait to do the loan to take a lower interest rate. But the good news is you're paying yourself back, right? You're not paying credit card company back. So even though it's a higher interest rate than it was during COVID, at least the money's going back to you and not to MasterCard. So that's the second advantage of doing the solo K over the SEP. The third, I would say, is the ability to do the mega backdoor. I just think it's a huge advantage to be able to go Roth 69K or 76.5 dollar for dollar. When I say dollar for dollar, I mean if you make like 75K and you're self-employed, you pretty much put all the way in Roth. SEP IRA, it's a profit sharing plan. It's 20% of your Schedule C or 25% of your W-2. So it's a really big advantage. Starting in 24, the SEP rules do allow you to go Roth, which is great, but it's not going to let you go Roth dollar for dollar. So I think that's a really big advantage, and that would be my number 3. My number 4 would be for real estate investors. If you want to use leverage, a solo K under Section 514C9 will let you use leverage by way of a non-recourse loan and leverage up your real estate and not pay any UBIT tax, which can go up to 37% tax on an IRA. There's an exemption for 401k plans that use a non-recourse loan to acquire real estate. And I think that's a pretty massive opportunity. So if you're a real estate investor, you obviously love using leverage. so long as you can acquire a non-recourse loan, a loan you do not personally guarantee. You can use a solo K, leverage up that asset to buy real estate and pay no UBIT tax, where if you did it in an IRA or a Roth IRA, you would be subject to this potentially 37% UBIT tax, which could potentially kill the tax benefits of the transaction. So that would probably be my fourth advantage of doing a solo K over a SEP. And if you're a real estate investor, that probably would go to number one on your list, because using leverage without tax is a game changer, especially if you can do it, in a Roth. It's a massive tax planning opportunity. My fifth advantage of the solo K over the SEP would probably be asset and creditor protection. Solo Ks have a stronger asset and creditor protection outside and inside of bankruptcy, based off 2005 Bankruptcy Act. 401ks generally have unlimited creditor and asset protection. IRAs, limitations, a little bit over $1 million. Most states who will offer asset and creditor protection outside of bankruptcy generally provide 401k plans greater credit protection than IRAs. So that would be my fifth. My sixth would be really from an administration standpoint. If your plan is less than $250,000 in the solo K, you have zero filing requirements. With a SEP IRA, your IRA custodian will file a 5498. So there's always a filing requirement. Whereas in the solo K, if you have less than 250K, there's zero filing obligations. If you have more than 250K, which you hope you would do and have at some point, don't worry. IRA Financial, if you're a client, will handle the 5500 EZ, the 1099R, and all respective filings. Starting in 2024, there's something called the Corporate Transparency Act, CTA, which means if you have an entity owned by an IRA or 401k, there is a beneficial ownership interest form that needs to be filed with FinCEN. The good news is both a SEP and a solo K do not need to file the CTA or the BOI with respect to the CTA to FinCEN. Only it would apply if the IRA or the solo K owned an LLC or an entity, and that entity was managed by, let's say, an IRA owner or a 401k trustee. Only in that context would the IRA owner or the 401k trustees info have to be reported to FinCEN by way of a BOI report. Otherwise, there's an exemption for IRAs and 401k, so you wouldn't have to worry directly if, for example, your SEP IRA or your solo 401k invested directly in an asset without the use of an entity. There would be no BOI filing requirements based off responsible party or even ownership, because the ownership would be ignored since it's a retirement account. Even if the retirement account owned more than 25%, BOI would not have to be filed on ownership. And if the responsible party is not the IRA owner or the 401k trustee, then no information with respect to the IRA or 401k in that investment transaction would need to be reported to FinCEN. Again, if you have questions on BOIs, FinCEN, CTAs, we'll help you out if you're a client. That's something we're going to actually be doing filings for checkbook control structures or solo 401k LLCs or a solo 401k that does a blocker. We will handle that filing obligations for our clients. We're probably going to be one of the few companies in the space that does it. So hopefully that's another reason why you want to work with IRA Financial. We're the best at what we do, basically because we don't just set up the structure and kind of leave you on our way. We focus on ongoing compliance, ongoing audit support, and ongoing consulting services, which we think ultimately is what is the most important and what we believe is the reason why we've never had a client, under any, IRS audit or scrutiny for any IRA or solo 401k transaction, is because we focus on the consulting and making sure clients are aware of tax filings, whether it's CTA, BOI, whether it's 5498, whether it's prohibited transactions, whether it's UBIT, it's qualified person rules. We want to make sure our clients have all the most updated information. And if they don't, it's okay. We'll help them. So all they need to do is, you need to do if you're a client is email us, call us, contact us, text us. and we will provide you the necessary support you need. So I think when you add it all together, the only time the SEP IRA beats the solo is if you're going to max out, you're under 50 years old, you don't care about a loan, you don't care about using leverage in real estate, and you just want to max out at 69K, you make enough money to do that, the SEP will work for you. But otherwise, if you are a real estate investor and wants to use leverage, you want to supercharge Roth, and you're not able to max out dollar for dollar in a profit sharing context, then the solo K, I believe, will beat the SEP IRA almost every time. I'm biased. Yeah, I wrote a bunch of books on the solo K, but it's just the truth. The numbers don't lie. When you have the loan feature, the exemption from UBIT for real estate acquisition, asset and credit protection, easy admin if you have less than 250K, I think it's a no-brainer. You know, I've said this, I'll say it again. If I could, I'd put every single one of my clients in a solo K. It just doesn't work that way because not everyone's self-employed, right? You got to remember eligibility. Any business could set up a solo or SEP. It could be a sole proprietor, single member LC, C Corp, S Corp, partnership, even a charity. It doesn't have to be your full-time job. It could be a side gig. You can drive for Uber or DoorDash, or you can sell stuff on eBay or whatever. You just need to have a side business. It could be, again, Schedule C. It could be a corp. You have to have the anticipation of profit. You know when you're in business, right? Like my kids are not in business. They sell, you know, they trade baseball cards or football cards, or, you know, sometimes they bring their Nike Dunks and try to sell them at a shoe convention. It's not a business. You know when you're in business, right? You just know. So if you have a full-time job, you're an executive, but you do some consulting on the side or drive on Uber on the side just to hang out with people and make a little bit of money, you got a side business. And you're eligible to shelter some of that income from tax. Now, I get this question. Hey, Adam, I max out my solo K at work, or my 401K at work, excuse me. But I have a side business that makes 30K. What can I do? Well, if you're in 24, if you max out, if you're under 50 and you hit the employee deferral of 23K, or over 50, 30,500, if you have a side gig, and let's say you make 30K, you can do 20% of 30. Or guess what? You could do a mega backdoor of all the way up to close to 30, taking away FICA and Social Security taxes. So let's say 26 or 25, all the way into Roth. Now, if you want tax deductions, you already did the employee deferral, so you can't double dip, but I can get you the profit sharing of 20 or 25% if this C or S Corp. Or if you don't care about deductions, I can get you into a mega backdoor that will let you go almost all the way to 30K in a mega backdoor, as long as you can't go above, obviously, the 69 or the 76.5, incorporating, you know, employee deferrals. So it's exciting. The solo K is a great plan. There's so much you can do. There's some controversy. I'll probably do a different video about this soon, but there's something called automatic enrollment, which generally applies to ERISA 401K plans. But there's some controversy because it seems the way the Secure Act 2.0 was written last year is that it seems to allow a solo K to get a $500 tax credit for 3 years, up to $1,500 if they auto enroll. But auto enrollment really doesn't apply to yourself, right? It's something you give your employees. But based off the way the Secure Act 2.0 is written, based off the auto enrollment calculator, it seems that you could get a credit for a solo K, not a SEP IRA, of up to $1,500 over 3 years for doing a solo K, so long as you check off the auto enrollment box, which we can check off on your plan docs, but again, isn't kind of relevant to solo Ks, auto enrollment for ERISA plans for non-owner employees. So to be continues, I have some calls in to some folks in the IRS to just confirm this. I haven't gone live with it or written a blog because I'm still not sure. I'm like, it seems like you could do it. I've seen some language out there, some blogs, but until I get confirmation from sources I trust, I haven't gone public with it. This is kind of the first video or public statements I've made on the ability to get a $1,500 tax credit for the solo K. I've still been super cautious. I didn't talk about it last year either because I wasn't able to get confirmation. I had a couple of attorneys say yes, a couple say no, but I'm getting pushed to publicly make a statement on it. So I'm close. I'm just not there yet. I don't want people trying to set up plans, get a credit, and be denied, and have a false statement out there. So I've been super conservative. But it doesn't make sense. I think if it is allowed, it was a mistake when Congress or the Senate, when they finalized Secure Act 2.0. It seems like it only should apply to to ERISA plans where there are non-highly compensated employees. Because why would they give you a credit for a business owner to set up its own plan and auto-enroll? Like, it's your plan. Why are you going to auto-enroll yourself? You're going to obviously be interested in make contributions. Who cares if you're auto-enrolled? The auto-enrollment is for your employees, right? The non-highly compensated, to get them to save more. The idea is if you auto-enroll people, it's a good habit. Automatically, the contributions get pulled from your payroll, and you're just going to save more because you're just not going to know about it or think about it. But if you're a sole proprietor, I mean, technically, if you own 5% or more of your business, you're highly compensated. But it just doesn't make sense. There's just a big divide, and I just haven't been able to get confirmation from the IRS. So it's out there. There's a potential to get credits over the last 3 years if you set up a plan. For new plans, I'm not sure, to be honest. So I'm going to wait to do a more formal video and blog on it. I just want to kind of throw it out there just as a teaser that it's possible. So that's it in 2024. The big changes, obviously, contributions are up 69 and 76.5 if you're over 50, from 66 and 73.5. The SEP is from 66 to 69. Employee deferrals in a solo K is 23 if you're under 50, 30,500 if you're over 50. That's up from 22.5 and 30 and 23. The big change in 24 is the Corporate Transparency Act, which should not apply to SEP IRAs or solo Ks. The only time it would apply is if those plans are invested in an entity and there's a responsible party that's either the SEP IRA owner or the 401k trustee. Otherwise, much is the same. One other change for a solo K, which I'll talk a lot about this going forward, is now filing the 5500 EZ, you're going to have to confirm like the plan opinion. So they're going to want to make sure you actually have a plan opinion, which for my clients is not a problem. All IRA Financial clients have their own opinion letter, so it's not really an issue. That's it. If you guys do have questions or comments, please leave them below. If you are a client of IRA Financial, you have questions or comments, let us know. We're here. We're standing by. Our team is awesome, and we'll help you. If you're not a client of IRA Financial and considering a SEP or solo in 24, call us. Challenge us. We will answer your questions. And if we don't know the answer, we'll find it. We don't just throw out any answers. We will research it, no cost. There's no consultation fees. We are here to help. With over 25,000 clients, $3 billion in assets. I think we're the best for a reason. And the reason is we care about each client, and we want to put every client on the right plan, whether it's a SEP, solo, IRA, IRA LLC. And we want to not only just set up the plan, but be there for you and offer you the ongoing consulting admin services. So your plan could stay in good compliance. You could focus on your business, what you do best, and let us focus on what we do best, which is taking care of your self-directed IRA or solo K. So that's it. Happy New Year. I hope everyone has an amazing 2024. I wish everyone only great things, happiness, health, prosperity, and subscribe to this channel. I go live whenever I want, right? Sometimes it's Wednesday, Thursdays, and if something pops in the news, maybe it's Monday. So if you subscribe, you'll get notified when I go live. It's free. Like, what are you waiting for? You're going to get awesome content, up to 3 podcasts a week, 3 to 4 videos a week, alive. If you're interested in learning more about self-directed retirement plans, alternative assets, there's not a better platform out there. I promise you. This is what I do all day. I spend literally all my time on content. I hope you enjoy it. And if you have comments, questions, let me know. Love to hear from everyone. Happy New Year again. And I will look forward to spending a great year with everyone. Take care and see you soon.